Staying on top of all the developments in finance, business, and economics can be exhausting. Between everything becoming an excuse to gamble, corporate consolidation of markets, political influence driving massive asset bubbles, extreme wealth inequality, spiraling consumer debt, diminishing savings, stagnating wages, unaffordable real estate, and deepening generational wealth divides, all stitched together by questionable government programs. It's enough to make anyone feel overwhelmed. But just remember, it could be worse. We could be Canada. And if that wasn't bad enough, there's actually a country pushing these issues even further. A cautionary tale of how bad things can get while somehow still holding on. Let's call it Canada with snakes. Australia, a nation once celebrated for its enviable standard of living, robust middle class, and seemingly stable economy, is quietly unraveling beneath the surface. With around 200,000 electronic poker machines, known locally as pokies, scattered across pubs, clubs, and casinos, and minimal safeguards like daily loss limits of just $100 and annual caps of $5,000. Australia holds the dubious distinction of being the gambling capital of the world per capita. Meanwhile, its housing market has spiraled into absurdity. The average property now costs more than 8 times the median household income. In Sydney, rental prices have surged to levels that would shock even the most jaded New Yorkers or Londoners, with reports revealing taxpayer money has even been funneled into questionable programs, including drug-related expenditures, in a desperate attempt to manage social fallout. For decades, Australia appeared to be an economic success story. UBS's annual Global Wealth Reports, the successor to Credit Suisse's, consistently ranked Australians among the wealthiest people on Earth. Unlike GDP per capita, which measures output, these reports assess net worth, how much people actually own after debts. This distinction matters. A high earner in San Francisco spending every dollar on rent and avocado toast isn't building wealth, whereas a modest income Australian paying off a home and contributing to retirement savings might be. And for years, Australians looked like the latter, deliberate, steady wealth builders. The 2025 UBS Global Wealth Report reaffirmed this. Australians held the second highest median net worth globally, trailing only Luxembourg. Crucially, it's the median, not the average, that tells the real story. The typical Australian is more than twice as wealthy as the typical American. In the US, averages are inflated by billionaires, masking widespread financial fragility. In Australia, wealth seemed broadly shared. So why title this Australia's quiet collapse? Because that wealth is built on sand. Australia's prosperity hasn't come from innovation, diversified industry, or sustainable productivity. It's come from luck. Specifically, luck in 2 areas: dirt and debt. Either you dig resources out of the ground and sell them to Asia, or you buy, sell, and leverage property back and forth in an ever-inflating real estate bubble. That's it. There's almost no third path. This isn't speculation, it's measurable. The Economic Complexity Index, which ranks countries by the diversity and sophistication of their exports, places Australia extremely low among high-income nations. Australia's dependence on raw commodities, iron ore, coal, natural gas, and livestock, remains pronounced. This isn't just economically risky, it's strategically fragile. When global demand shifts or decarbonisation accelerates, Australia has no ready backup plan. Worse still, the country has repeatedly failed to capitalise on its own innovations. Australian researchers helped invent Wi-Fi, pioneered key solar panel technologies, developed life-saving medical devices, and even laid groundwork for Google Maps. Yet none of these became major Australian industries. Why? Because investors, domestic and international, preferred the predictable returns of mining over the uncertain bets of tech startups. The result? Groundbreaking ideas were commercialized overseas, enriching Silicon Valley, while Australia remained tethered to digging holes in the ground. This dependence has warped the entire financial system. For years, the Australian dollar moved in lockstep with commodity prices, turning every local investor, willing or not, into a resource speculator. While that correlation has softened somewhat since the pandemic, that decoupling may be a red flag, not a relief. It could signal that Australia's resource-driven model is reaching its limits, and the economy is drifting without a new engine to replace it. Beneath this fragile foundation lie deeper societal fractures. Gambling, for instance, isn't just a vice. It's an industry woven into the national fabric. Australians lose nearly $1,000 per person annually to betting, lotteries, pokies, and sports wagering, even accounting for non-gamblers. Pubs double as mini casinos, horse racing enjoys public holidays, and online betting ads saturate TV broadcasts. The US gambling boom post-2018? American venture capitalists are explicitly modelling it on Australia, hoping to replicate its success. But that success comes at a cost: rising fraud, family breakdowns, mental health crises, and youth addiction. Yet meaningful regulation remains elusive. Why? Because the industry employs thousands, and politicians fear the backlash of closing a single pokie machine in a rural pub. Sound familiar? It's the same paralysis that protects mining subsidies and real estate tax loopholes. Speaking of mining, while Australia sits atop vast natural wealth, much of the profit flows offshore. Foreign-owned mining giants extract billions, while the government, under intense lobbying pressure, has repeatedly abandoned attempts to implement a proper resource rent tax. Instead, it offers grants, tax deferrals, and exploration incentives to keep the sector competitive. The official line? These policies de-risk investment. In reality, they entrench dependence on an extractive model that enriches shareholders far more than citizens. Then there's superannuation, the crown jewel of Australia's financial system. Unlike America's voluntary 401ks, Australia mandates employer contributions, currently 11%, into retirement accounts. This has created a massive pool of savings, now valued at several $trillion. But here's the catch. Australia's domestic investment opportunities are so limited that over 40% of superannuation funds are invested overseas, especially in US equities. Australian startups in biotech, clean energy, or software often list on NASDAQ, not the ASX, because local capital prefers real estate, mining, or gambling stocks. So Australia saves diligently, only to fund America's innovation economy. And all this saving is increasingly consumed by housing. The average first home buyer is now 36 years old, with the fastest growing cohort aged 40 to 49. Mortgages stretch 30 years, and many retirees use their entire superannuation payout not for travel or leisure, but to pay off their home. Just to qualify for the government's age pension, which excludes owner-occupied housing from asset tests. This isn't wealth creation, it's financial contortion. People are liquidating retirement security to achieve basic housing stability. How did housing get so unaffordable? A toxic mix of factors: decades of underbuilding, restrictive zoning, NIMBYism, record immigration, and critically, a tax system that incentivizes property speculation. Australia's marginal tax rates remain steep, but reforms, including recent tax cuts, have softened top brackets. The loophole of negative gearing persists. Investment losses, including paper losses from property depreciation, can offset taxable income. This practice, in effect, turns high-income earners into real estate investors. They borrow to buy property, claim losses against salary, and later sell for lightly taxed capital gains. Economists across the spectrum agree it's distortionary and unsustainable. Yet reform is politically near impossible. Too much wealth, debt, and voter sentiment are locked into the status quo. Immigration compounds the pressure. Australia's 2025 to 26 permanent migration program has been set at 185,000 places, mirroring the previous year's intake. Around 71% of those places target skilled migrants, while 28% go to family visas. According to evidence, over 40% of Australia's millionaires were born overseas, many arriving not to build businesses, but to park existing wealth in Sydney or Melbourne real estate. This influx fuels demand without corresponding supply, pushing prices further out of reach for locals. The result? A nation where prosperity is increasingly performative. Banks appear strong, but are overexposed to housing debt. Wages stagnate while living costs soar. Productivity growth has flatlined for over a decade. And beneath the glossy reports of high median wealth lies a generation locked out of home ownership, burdened by debt, and watching their retirement savings vanish into mortgage payments. Australia isn't collapsing overnight. There's no imminent crisis yet. But that's the danger. The system is designed to delay consequences, not solve problems. As long as commodity prices hold, immigration inflows continue, and superannuation keeps recycling money into overvalued assets. The illusion persists. But illusions don't withstand shocks. A global recession, a sharper drop in Chinese demand for iron ore, or sudden interest rate shocks could expose the fragility beneath. For the rest of the world, Australia serves as a warning. It shows how easy it is to mistake asset inflation for real wealth, regulatory capture for stability, and delayed reckoning for success. The quiet collapse isn't dramatic. It's gradual, systemic, and masked by impressive headlines. But make no mistake, when the foundation is dirt and debt, even the tallest house won't stand forever. So if you're feeling uneasy about your own country's trajectory, take note. Australia's story isn't unique. It's a preview. And if there's one lesson to take away, it's this. True wealth isn't measured by the value of your home or your super balance. It's measured by resilience, diversity, and the ability to adapt when luck runs out.